Good morning. Welcome to Stock Market Today. It's Tuesday, March 3rd, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Shaken Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Shaken Analytics. Head over to shakenanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. And that hits your inbox every trading day before the market opens. So U.S. equities closed strongly higher on Monday. All sectors are positive, with defensive sectors leading the way. Industrials and energy lagged, but we're still up over 2%. Treasuries weakened late in the session, with yields finishing slightly higher across the curve. The dollar was stronger versus the yen, but weaker versus the euro. Gold was up 1.8%, and WTI crude weak. As we get to the desk this morning, futures are higher, but they've been all over the map this morning. Asian markets were mostly higher overnight, led by China and Taiwan. European markets are trading higher as well. Treasuries are under pressure. The dollar is weaker versus the yen and flat on the euro cross. Gold is adding on 60 basis points to the upside, and WTI crude is following through a bit as well, up nearly 3% to get us going on a Tuesday morning. So as we look at the structure of the S&P 500, we've had a strong rally from Friday's lows to retake the 200-day moving average on a closing basis. Support is in the 2,900 to 3,000 range. Resistance is in the zone between 3,100 and 3,200. Interesting to me, if you recall, we showed you the chart last week of the key retracement levels for the SPY. That kind of lines up with the S&P 500. We tagged the 50% retracement level in Friday morning's trading before the rally ensued. RSI leaves oversold levels, but for now is still in bearish ranges, and Chaikin money flow is back to a slightly bullish position after this brief dip down into bearish ranges. So let's call the indicators mixed. Strong rally from that 50% retracement level, retake the 200-day moving average. But, there was a lot of technical damage done last week. It may need some time to play out and chop around. We can't really roll out a retest or a move back towards the lows. So I think the best bet is to stay nimble out there if you're looking for opportunities. If your setup is there, it makes sense, but be sure to manage your risk as always, but more so now. I think if anything we learned last week, having a solid risk management discipline is extremely important in all market environments. Turning now to our market in a minute. What are we writing about? Well, strong rebound from Friday's lows continues. Financials break relative support as rates fall, right? On Tuesdays, we look at relative strength across the market in our note to clients, and we try to see in a case of what happened last week, really when there's a precipitous decline or any kind of decline really in the market, we want to look to find the sectors that held up the best, because those are your likely leaders once prices do begin to stabilize. So financials, not part of that group, right? They broke relative support as rates fall. Tech, healthcare, and comm services did fare the best last week on a relative basis. Healthcare momentum provides leadership. There's actually a fund to take advantage of that dynamic in the market. We'll take a look at it a little bit later in the show. Finally, futures, as I said, do point to a higher open here today. Taking a look at the major indices now from a power bar perspective, all still skewed in favor of the bears. The Dow added 4.9% yesterday, 2 bulls to 7 bears there. S&P 500 up 4.2%, 34 to 119, bulls to bears. NASDAQ was an outperformer, 13 to 18 bulls to bears. Small caps lagged, right? And you can really see that they lagged a lot, up 2.6% on a day when the S&P 500 was up 4.2%, 178 to 422 bulls to bears there. After rallying, bonds faded throughout the afternoon, actually closed lower on the day, sending yields higher. And if you take a look, yesterday's leader from a sector standpoint was one of the more defensive areas of the market. Utilities up nearly 6%. XLU, 2 bulls to 1 bear there. So according to the Chaikin Power Bar, small cap stocks and large cap stocks have turned bearish. Major markets across the board are mixed. Taking a look at our stock of the day now, and this is kind of an interesting one to me. If you're looking for names that held up well during last week's sell-off, i.e. sold off less than the overall market, I think you want to take a look at a name like Microsoft, ticker MSFT, has a very bullish Chaikin Power Gauge rating due to very strong earnings performance, very strong price volume activity, as well as positive expert activity. The stock does have poor financial metrics. However, when we take the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating for a stock that's in a strong trend. Closed yesterday above the still rising long-term trend line. Now, the group is weak. The industry group rank is really based on the power bar ratio, and they've all pretty much turned negative over the past week. But if we look at the structure, of Microsoft here, very bullish stock, outperforming the market. So, type of name that we want to consider. Stock is currently oversold, and the overbought oversold indicator is rounding higher within that oversold condition. Now, the sell off did cause Chaikin money flow to move to a more neutral stance. But if we take a weight of the evidence approach and we're looking for potential opportunities following sell offs for names that have held up well and are starting to stabilize, I think you can take a look at a name like Microsoft here as it rebounds back towards the 170 level, back above the long term trend line. And look at what's interesting to me here is the fact that the stock held up really well. And actually is beginning to see the intensity of its outperformance increase even as the market was selling off. So when we talk about looking for leadership in the market, Microsoft certainly fits that bill. I can't argue with Microsoft as a positive idea here. If you're looking for names that held up well as the market sold off. Taking a look at our sector tracker now, movement here, the major sectors over the last 5 days, all still negative over the past 5 days of trading, as you might expect. But technology, which has been one of our favorite areas of the market, has snapped back and is outperforming, at least on a relative basis, down less than 2%. Healthcare and comm services, two other groups that we like. Remember what I said, if we want to look for the sectors of the market that have held up the best through all the volatility in the market, tech, healthcare, and comm services certainly fit the bill. Staples benefiting from defensive positioning, but I will point out that the XLP has a bearish ETF power gauge rating at Chaikin Analytics. Discretionary utilities, financials, and materials are middle of the road. REITs, industrials, and energy towards the bottom of the list. Energy and materials have very bearish Chaikin power gauge ETF ratings, and energy just continues to decline on a relative basis. Just not an area of the market where we're focused for bullish ideas. Don't want to catch the falling knife in energy. And if we're looking at relative strength within the energy complex, it can only be described as a falling knife. Taking a look now at our industry in focus, it's capital market services, which over the past 6 months has been a very slight underperformer, lagging the S&P 500 by 5 basis points. However, one of the few areas where the power bar ratio, which measures future potential, is still strong. 10 bullish or very bullish stocks there for 5 bearish or very bearish stocks earns it a rank of number 2 of 21 subsectors that we look at. Now, some of the indicative names there, again, this is auto-generated. Legg Mason and E-Trade have some M&A activity in play there, but Interactive Brokers is a very bullish stock that actually looks compelling to me. We're going to take a look at why I think Interactive Brokers looks compelling, right? First, IBKR has a very bullish Chaikin Power Gauge Chaikin Power Gauge rating. Trend is strong. Notice that this stock never broke below the long-term trend line, as many stocks did last week. And the industry group, as we said, is still strong. Now, what we see is this consolidation that's been playing out for the past 12 months. But what's interesting to me now, despite still being in the consolidation, is what we call a personality change. Notice that the stock was a solid underperformer for most of the past 12 months. But in February, started to perk up on a relative basis. And we've actually seen the intensity of outperformance pick up as the market has sold off, right? Now, Interactive Brokers were not spared from the sell off. We declined from around $58 to $50, but that decline was less intense than what we saw in the S&P 500, causing the relative strength to improve. At the same time, we're seeing a pickup in Chaikin money flow, right? So it seems stock seems to be under accumulation. So what do we have? A very bullish stock leading the market with bullish money flow is now oversold. So a few ways to play this one. You can kind of take the signal here and follow the process. If you'd rather wait for a breakout through the $58 level, I can't argue with that strategy either. Regardless, you have to know yourself. And I think Interactive Brokers, if you're looking for ideas as the market, maybe beginning to stabilize, Interactive Brokers actually looks compelling as a potentially bullish idea here. Take a look, definitely worth doing more work, and notice that it did outperform on the day yesterday. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers. Costco, a lot of news over the weekend showing the lines at Costco and the empty shelves as people are preparing for some of the potential fallout from coronavirus. That stock higher by nearly 10%. Defensive stocks did well yesterday. That helped AES. CCI, also part of that defensive group. It's a REIT, one of the cell tower REITs. Those all traded well yesterday. SPGI, didn't see anything company specific to drive that stock higher by 8.83% yesterday. And Apple caught an upgrade from Opco and just had a big move higher on the day. up 8.8% for Apple with a bullish rating here at Chaikin Analytics. On the loser side of the board, completion of a merger for IR, stock down 15%. Norwegian Cruise Line still seeing some fallout from coronavirus fears, down 4.3%. Live Nation giving back some of the gains from Friday after they reported earnings. Now, management did comment that they have not seen coronavirus fears yet, but this name is certainly caught up, right, with the leisure areas of the market that have been hit hard over the past week and a half. VTR, nothing company specific to drive that stock lower by 2.16%. Same with Gap Stores, GPS, with a bearish rating down nearly 2% on the day. Didn't see any company specific news there. Consumer discretionary group was relatively mixed, especially in and around the soft lines area of that sector. So let's dive in. We do relative strength at the sector level on Tuesdays, as I've said. Financials break relative support. Here's XLF relative to the SPY, right? And been in a downtrend that tried to stabilize and move higher as rates moved higher. But as rates have now started to decline again to start the new year, not really the new year anymore, but you get the point. Financials have seen their underperformance begin to intensify. The ratio has fallen below the 200-day moving average, was trying to find some support at this near-term rising trend line, but that has subsequently broken. The ratio actually traded to a new 52-week low. Now we're looking for signs of stabilization. Rates, remember yesterday, rates got down close to 1% on the 10-year. So declining rates are a headwind for the relative performance in financials, especially the banks. As we take a look at the RSI of the ratio, you can see that during the last move higher did not become overbought, actually left a negative divergence on the chart. And the ratio, the RSI has now moved back into bearish ranges, becoming oversold a few times over the past couple of months. So some downside momentum with the break of support as we look at the RSI of the ratio. And if we look at XLF on an absolute basis, you can see that the uptrend line off the late 2018, early 2019 lows has been broken as well. So it's hard to get excited about financials unless and until we see a stabilization in that decline and in that downtrend in interest rates. So just wanted to point it out. Seems interesting to me today. Technology remains a strong relative trend, right? Really, hardly wavered, at the end of the day. XLK, tech selector sector, SPDR fund relative to the SPY, right? Solid uptrend above the 200-day moving average, confirmed by momentum, did become overbought near the highs. Now, we did comment that it was extended a couple of weeks ago and that we wouldn't be surprised to see a near-term pullback, and that largely played out. But what's interesting is that on the pullback, the RSI did not leave bullish ranges, right? Stabilized and held this level just below the 50 mark. So that indicates that there's still some solid momentum behind the relative trend for technology, right? And if we look at tech on an absolute basis, you can see the clear uptrend at the bottom of the chart from the late 18, early 19 lows. That uptrend line was tested last week, and we've begun to see a rebound. So again, if you're looking for the areas of the market that held up best as the market sold off last week, you have to be paying attention to an area like technology. We often look at how semiconductors are performing. We showed that chart a couple of times last week. Relative performance of semis holding near-term support. So I think if you're looking for ideas, you want to go looking through the tech sector for stocks that held up well as well, right? Stocks that look like what we showed you earlier on the Microsoft chart. Certainly an area of the market where we want to have some focus. And then finally, healthcare momentum is emerging leadership. Take out the fund to take advantage of this. The healthcare momentum ETF breakout holds above the breakout level, retakes the 50-day while remaining above the 200-day. On the sell-off last week, never became oversold. And look at the relative breakout here. PTH is the ticker symbol, the Invesco DWA Healthcare Momentum ETF, breaking topside on a relative basis, tells us that this group is likely to continue to show some relative strength. You can drill down on the holdings there and look for individual ideas. That'll wrap us up for today. Head over to chaikinanalytics.com/test drive, where you can sign up for a free 14-day trial and follow along with everything I'm talking about here. Have a great day, everyone.